Okay, so today we're going to be talking about the shift we've been seeing in the market. So I'm just going to go ahead and jump into it. So my name is Ivory Becker. I am the owner of Insight Strategies. We focus on credit restoration as well as credit education for both professionals and consumers. I utilize my 14-year background in lending, regulatory compliance, and default management for us to be successful, both in understanding the credit models, all of the different algorithms, how FICO works, how it impacts lending opportunities, and then in the process of working with clients to restore damaged credit. So we've all heard this before: to stay relevant and solvent, you must adapt. So Shant, and I'm going to butcher his last name, so I'm just going to call him Shant B, with Guaranteed Rate, had a great quote I read the other day. And he's one of the top loan officers in the country who funded $2 billion in total loan volume just last year. So he said it's going to be a different kind of business. Every year the market shifts, and as a professional, you have to shift with it, and you have to set your sights on how you can add value to your consumers and referral partners. So recently we've seen uncertainty for home buyers and mortgage brokers. There's been concerns about the rising inflation and a recession. The low rates had really driven a lot of business. And from all of that demand, one could argue too much demand, the prices of housing was really driven up quite a bit as well. So this does have to be pulled back. And there's been quite a lot of wealth that's been created over the last several years through the increases in home prices, causing a lot of equity for people. Income has increased due to labor shortages, causing employers to compete over what labor there is out there. And with that, payroll has increased with job growth. Income levels are still higher than what they were, and there still is a shortage in housing inventory, even with interest rates and borrowing costs increasing. There's still an existence of that high demand and low inventory environment. So it's important to also remember that rent prices are also still very high, with the average rental increase of 14% in 2021 alone. So in many cases, renting is still not a cheaper option for most consumers. And people are looking for alternative solutions to renting, with a new projected increase of a 10% rate hike, or rent hike, if you will, from the Federal Reserve. So people are still seeing that buying a property and that potential of the strong appreciation can make homeownership very enticing and still very valuable. And we are seeing a lot of people utilizing real estate for other income streams as well, renting out a piece of their property, and utilizing that for short or long-term rentals. So what's actually shifting? We see many younger groups buying into the market. Younger groups have driven a change to more digital processes when it comes to mortgage applications as well. Also with this comes the desire to be educated digitally. Millennials are showing a strong desire to create financial futures that are successful for themselves and for their families, and are utilizing technology to become more financially literate and educated. So along with that, what we also do see is millennials do have lower credit scores than the older generations. And we can also see that non-bank lenders have grown to take up 70% of the market share when it comes to the mortgages that have been taken out by consumers. So this growth has been driven by a handful of outperforming banks that have a really strong digital focus. So they're really buying into the demand from those younger generations wanting to be more digitally focused. They've adjusted to that demand by creating a higher perceived value through ease of process. And this is through utilizing the online platforms for the entire loan process. Makes everything easier. We like easy, right? So what happens though when all of the lenders on board have all of these same advantages? How do you stand out as a single loan officer at whatever company you're at? Well, the focus should still be on the value you provide to your consumers, but what that value is may have to shift. So when loans are not falling from the sky, it's back to the basics, and many things that were previously taken for granted come into light again. So educating clients on what they need versus what they want is going to be imperative. And having the tools and resources available to meet those needs and forming thoughtful business alliances are going to be the foundation for good customer relationships, and then also open communication for everyone involved in that transaction. So those are some of the basics that may have been forgotten over the last several years when it's been a bit easier to find mortgages or to give loans to people. So this means we have to have a change in our mindset as well. Lately, we've been hammered with a lot of doom and gloom from the media, and it almost feels as if professionals and then consumers alike are holding their breath and kind of waiting to see what's going to happen. There's a lot of people that just don't know what to do. And home buyers are understandably very discouraged by the higher home prices, the rising rates, inflation as well, and feel that sitting on the sidelines until things look more favorable may be the best option. But the problem with that is the perfect market isn't waiting for them, and it will never be there. It's like the investor that's always trying to time the stock market. They'll never time it exactly the right way. And there will always be that friend that they heard got the best deal at the best time, at the best rate. While that home buyer sits on the sidelines, prices keep rising. Showing them how to solve their problem or achieve their goal, and then focusing on how that achievement will make them feel is the only way to change their mind from sitting on the sideline. The only tool available to curb inflation is the rising interest rates. So it makes sense that we are seeing this transition. And before the rates did change, Americans with excellent credit were the ones that were taking up most of the market share. The median credit score was 786 for the ones who got most of the new mortgages. And that's a substantially high credit score. And many of these new mortgages were refinances to take advantage of those record low interest rates. So now mortgage rates are starting to increase again. So what does this mean for you? Those borrowers who have already secured mortgages at great rates are likely to not refinance, of course, why would they? And they're likely not to move into a new property to preserve their low interest rates unless they're forced to. So we could see a rush of consumers trying to secure a mortgage while they can, which means seeing even more applicants who might not fall into that ideal, easy scenario of great credit, as well as great income and low debt. With higher interest rates and still higher sales prices on homes, it's going to be even more important to have a focus on credit and credit scoring. So that's where we're at right now. And historically, housing has performed very well in recessions, with the exception of the 2008 crash, but especially in the case where we have a high inflation environment, because housing can be a great safe haven for cash. So as I said, the only tool available to curb inflation is the rising interest rates. This means the constant stream of the refinances and consumers chasing the low rates has ended. But higher rates don't stop people from buying homes, and that's important to remember. There's still value to homeownership through the form of creating an investment that creates generational wealth, or even can create the passive long-term income. So this puts purchases at the center stage. So how do you grow your market share or create more business volume? How do you increase the effectiveness of your marketing efforts? And how do you become a disruptor to your competition? We're going to answer some of those questions today. So it's like I said, back to the basics and focusing on things that we previously did take for granted. The easy flow of loans won't always be there, and there's always going to be a constant ebb and a constant flow in the market. So if you can capitalize on what your competitors can't, then you can be the one that closes more loans. When the pipeline gets smaller, the prospective borrowers that you previously set aside before begin to look like an opportunity when you probably ignored them. So what opportunities actually exist that you didn't see before? Instead of thinking short term, we're really focused now to look at the long term, right? We have the capacity now to plan long term, where before it was just trying to keep up with the day and make sure you get done everything you needed to get done for all of the people that were coming to the table. So when it comes to now having to think long-term, your business is going to be much stronger for being able to focus on that. So it is about shifting your focus and looking at this change or this transition as being beneficial. So let's dive into the opportunities. We're going to start by discussing purchases, and then we'll move into refinances later. But before we do that, let's look at the actual numbers. So over 69,000 Americans inquire about getting a mortgage, but only about 25,000 or just under 25,000 make it to the closing table. So that's only 35% of applicants. So this is income that is taken off of the table for you, right? You've likely spent many hours and cumulatively over the course of a single year, days or even weeks working with clients without any success of getting them to that closing table. All of the work you've already done can be saved, and you can prevent leakage in your pipeline with a higher conversion rate. So I want to ask you two questions. If you had the tools and resources to help you with credit, how many more loans could you close? And if the average commission, let's say, is $5,000 on a $500,000 house, how much more profit could you be making? Beyond that, what is the potential referral base you could create by making happier borrowers who you made a meaningful change in their life? For those borrowers, the process is not just a transaction. You're making a lasting imprint on them, on their memory and on their lives. You've helped them achieve something they probably didn't even know was possible. They're going to become what I call sticky clients. So they're going to be less likely to shop with your competition, more likely to send you their friends and family. And this is how you're going to make lasting business that creates success through any sort of a market environment. So what causes that 65% drop of people who inquire about a mortgage versus who actually get the mortgage and make it to the closing table? Credit is one of the top reasons a borrower is denied when applying for a mortgage, and it's closely followed, as you can clearly see, by debt to income ratio. And often these two factors are tied together. If you have a less desirable credit score, really anything under 700, you're paying higher costs for all consumer debt. Higher payments equal higher debt to income ratios. So that's pretty self-explanatory. Now, I know there are, of course, going to be some scenarios where the income just isn't there at all, even if debts are lowered, but let's focus on the scenarios we can control. And I want to pause there. I do want to pause there because I want to reiterate, you actually have more control than you realize when it comes to helping your clients with credit. And they also have more control than they realize to boost their credit. And it doesn't have to be a really complicated and convoluted solution if you understand the intricacies of how credit scoring works. So if you can help a prospective borrower get their score to 700 or above, this can give them more opportunity to meet the requirements to qualify for a more reasonable property with favorable terms, right? They're not going to be stuck trying to shop at a lower price range than what they want because they can afford more. And they won't be pigeonholed into particular loan products, right? They won't be pigeonholed into something like an FHA to meet the minimum credit score requirements. And then you're going to be more likely to see that borrower make it to the closing table. So it's more important to secure a process that can keep your pipeline full of applicants who can make it to the closing table with your help, since the floodgates of the amazing debt to income ratios and amazing credit score has kind of ended, at least for now. So did you know that only about 50% of loan officers look for credit improvement potential? So now many loan officers, because they're not looking for the credit improvement potential, are leaving tons of loans available on the table that you can scoop up from your competitors and be that hero for your clients. So how many applications do you think you've taken in the last year for people who don't qualify due to credit, or who qualify but decline to move forward due to the impact their credit is having on the terms of the mortgage product? So here's the problem. You likely don't know how to read a credit report, and you should, but nobody's really taught you. And this is true for most loan officers. And number two, if you did know the secrets to the credit formula, you would be able to close more loans. And you can gain those tools and resources necessary to become the expert, allowing you to close those loans that nobody else can. So you may have been thinking about this in the last couple of slides. What about the simulators and the rapid rescores that exist, right? Most loan officers utilize these tools if they are looking for credit score improvement potential. But there is so much more that you can do outside of these simulators and rapid rescore. Now, rapid rescoring often can't find the solution. And if it can, it's definitely not identifying every solution that exists. It's more heavily focused on paying things down. If X is paid down, then it increases the credit score by this many points. The problem with that can be not everybody has the funds to just pay everything down on their credit report to see that score increase. And if they did choose to do that, then they may be taking away from the down payment that they needed. And it may be negatively impacting their ability, again, to get the most favorable mortgage product. So rapid rescore or those simulators also don't look at what is not on a credit report. It's very focused on what's already on a credit report. So if you have the ability to identify what's missing that could optimize the credit scoring model or that credit report itself, then you could see an increase in point values that you didn't know, or that rapid rescore, didn't know was possible. So how many of you know how to read a credit report? And it's rhetorical, but if you answered, yes, I do know how to read a credit report, are you to the aptitude to where you can spend even 5 or 10 minutes reviewing the report and have all the answers for your client on exactly how they can create score increases without spending all of their money on paying down the debt? So you are here to get those secrets, of course, on how to read your client's report and see those actionable score changes. So before we get into that secret itself, let's lay down the framework that we can build off of. There's 5 factors that impact your credit score: payment history, credit utilization, or capacity amount owed. Basically, that's just how much your balance is versus your credit limit on revolving accounts primarily. The length of your credit history, credit mix, and inquiries and new credit. Now, there's a lot that goes into the understanding of how each of these factors influences the credit score, and we're not going to be discussing those details today since we just don't have the time. But we do offer a course that does go in depth on all of those details so you can better implement that understanding for your clients. And at the end of the webinar, I will give you a link to the course where you can learn a bit more. So there's a lot going on when you look at a credit report. And if you start by focusing on the score factors when looking at the report, this can be your cheat code. And I'm going to show you some actual credit report examples. So reason codes, these are the cheat code. This is the legend. It's the secret sauce to what's going on and creating the credit score itself. And there are many, many different reason codes depending on the different versions of FICO that are used. But here on the screen are some common examples of what you may see on a borrower's credit report. And then, like I said, we're going to look at some real examples next pulled from actual credit reports. So each credit report will show reason codes to indicate the top reasons for a decrease in the credit scores for that consumer. The reason codes will even appear on credit reports with strong credit scores too. The only way you will not see a reason code is on a perfect credit score. So there are typically up to 5 different reasons on each report, and they're listed in order based on the maximum point impact to the credit score to the least impactful. So if we were to look at each of the FICO factors, again, we've got payment history. You may see a reason code of serious delinquency. So they lost points due to imperfect payment history. If we think about FICO factor number 2, outstanding debt or that credit utilization, you may see a loss of points due to high balances in revolving debt. And that wording will vary depending, again, on that algorithm that's used. For FICO factor number 3, credit history length, you may see point values deducted for shorter credit history. FICO factor number 4, credit mix, you may see too many bank card trade lines, for example. Maybe they lost some points due to having too much open credit or not enough mixture of different types of credit. For FICO factor number 5, that's new credit and inquiries. So you may see points lost due to an excessive amount of inquiries or too many newly opened accounts. So, like I said, we're going to look at some real life examples. So this is what it looks like when you pull a credit report. Now, all of these examples come from a tri-merge credit report that a lender would see. From all different types of mortgage companies, there's going to be slight variances in what these look like as far as the layout on the credit report, but all of the information and all of the reason codes are going to be the same. So let me grab my pointer here so I can point to things. Okay, so you'll see we're broken into 3 sections: Experian, Equifax, and TransUnion. And right below the identifier for the bureau, you can see the credit score for that particular bureau. You can also see the version of FICO that's being used. Now, if you've ever attended any of my other webinars or seen some of my other videos, we talk a lot about the different versions of FICO, because those different versions of FICO, the algorithm itself and the way it interprets data can vary. So it can be very important to understand how the classic FICO that's used in mortgage lending varies from what your consumers may see when they're pulling their own credit from different resources outside of what you have. So again, these reason codes are in the order of what's most impactful to what's least impactful. So this can help you be more targeted for how you are going to approach increasing the credit score. Meaning for each specific bureau, you can be very targeted. Now, in this example, you can see the top reason that's pulling credit score down for this person is the length of time accounts have been established. And that is uniform across all 3 bureaus. Now, that's not always the case that you're going to see a uniform or the exact same reason codes bringing the scores down. Not every creditor reports to every bureau, and that can also be true for things that are derogatory, like collections would be the biggest example, or the most common you would see. So if we look at this example, we can see the main driver is the credit age of the file, right? By understanding the algorithm in a split second, you can say, okay, I have a solution for this. So when I look at a report and I see this, without even looking at anything else on the credit report, those individual trade lines, I can say, well, we can create longevity very easily on this credit report. All we have to do is have this borrower become an authorized user on their spouse's credit card. Let's say the spouse has a credit card that's been open for a very long time. We know we can make that person an authorized user of that spouse, and that's going to pull over the longevity from their spouse's credit file to their credit report, therefore clearing this reason code and then increasing the credit score. So by doing that, that will help to improve their credit score. Now you may be wondering, well, I see number 5 is too many accounts with balances. So when we think about adding that person as an authorized user, we're going to want to make sure that that card is a card that doesn't have a balance or has a very low utilization ratio. So that way we're not impacting this even more negatively. But we're still going to see a substantial lift in score, because remember, this is driving the score down the most for this person's credit report. When I look at this as well, I see that we have an issue of the level of delinquency on accounts, the number of accounts with delinquency. We see that again, time since delinquency is too recent, level of delinquency on accounts, right? So we're seeing some consistency here. So what I see when, because I understand the algorithm when seeing this is, well, why don't we crowd out some of this negative information by adding some cushion? I like to call it cushion, by adding some cushion to the credit file. This can be through different credit building tools that infuse positive history on the credit report, helping to diminish some of that impact from these delinquencies, right? In some situations, a borrower may not have the timetable necessary to do a full-blown credit repair process, or perhaps client doesn't want it, client doesn't need it. You're just trying to get 10, 15, 20 more points to get them to that next level. And the rapid rescore, again, it's not going to tell you how to solve length of time accounts have been established or level of delinquency. What it will tell you how to solve is the balances, but it is going to be ignoring all of these other 4 factors that are, reasons that are bringing the score down. So by having this knowledge, you can now not only have the solution for the balances, you get the exact dollar amount you need that client to pay down, but now you have these 4 other answers too. So adding an authorized user, creating a little bit of cushion. If they don't have time to work on the removal of the negative accounts, you've now created a lift that you didn't previously have. Too many inquiries in the last 12 months, not something you're able to solve for them. That is something that would take credit repair. But again, you have solutions you did not previously have, which can either help this person qualify for the type of loan product they want, or just get them somewhere better in general, right? So let's look at another example. So in this example, we see top reason for Experian is proportion of balances too high. So they have too high of a balance on their credit card. We see length of time on revolving accounts. So sounds like probably a newer credit card. And we see too many accounts with balances again. So on this one, we can see that there are definite differences across the 3 bureaus as to what's impacting the score the most. So when approaching a scenario like this, it would be important to focus on what bureau do we care about the most? What is the score we're shooting for? Do we need to focus more on TransUnion because we want that mid score to be 640, let's say, or 660, or 680, obviously it depends on where you're trying to get to in the product you need. But we may be ignoring these 2 bureaus because we don't care. We're using the middle score. So you may be focusing and saying, okay, to solve this problem for TransUnion, I would want to add an authorized user, create longevity on the credit report. Same solution as before. Too many accounts with balances, the drill there. Time since most recent account opening is too short. So basically the whole point of this example is to show you that you don't necessarily always need to focus on every single possible solution if you have a very particular goal, right? So that's kind of the lesson of this one, if you will. Okay, let's look at the next one. Okay, so next one, we have this scenario where we see serious delinquency, number of accounts with delinquency. Again, we have balances too high, length of time since credit's been established, inquiries impacting the credit score. So we kind of have an all over the board example. This may be the type of example where you look at it and you're like, okay, now these scores are pretty far away. I see that the primary issue is delinquency. There's not too much I'm going to be able to do here since the bottom factor is the length of time since revolving accounts have been established, right? If I add an authorized user, I'm not sure that's going to bump that client up, 100 plus points to get where they need to be. So this would be when you might say, okay, this client is in a position where they need the bigger guns. They're going to need something like credit repair. So I wanted to give an example of something that is a bit more severe where you may have to push that one off to an organization like us where we can fix their credit, and bring them up to that 700s within roughly that 6 months-ish time frame. So, all right. So this is an example where you can see that even with great credit scores, there are still reason codes that can help drive the scores higher. So the higher the scores are, the less impactful these reason codes will be to the score itself. So as a reminder, and what I'm focusing on here is a lot of this is looking at inquiries, right? Inquiries is like second on the list in this scenario. Inquiries are part of about 10% of the credit score. So we know it's not driving a ton of that point value down. These are excellent credit scores, but again, unless you have a perfect score, there's still going to be reason codes, right? And this too many accounts with balances, optimal balance on something like a credit card is between 1 to 9%. They could very well be at 25%, and that's impacting it, right? I guess in a scenario where we have portion of balances on credit limits too high, just to take us back to the prior one, one of the things that you could also look at on here is talking to that borrower and saying, hey, do you use your full balance every single month and then pay it off? And if their answer is yes, well, you may have an opportunity to request that that balance get updated so you can get updated credit scores, and tell them, can you just hold off on using that credit card just for a little bit while we re-pull your scores, because creditors are only sending the balances once per month, a couple days before the statement date. So if your borrower doesn't time that perfectly, you may have a really easy fix, because utilization is 30% of the score. So it's the biggest factor behind payment history, which is where this delinquency is factoring into, right? So you may have a lift that's pretty substantial and pretty easy to solve if it is just a timing issue. So thought I would throw that out there. Okay. So that's that example. Again, still reason codes, even with exceptional scores. So this is an example of what it looks like when there are no credit scores. So you can see there's a lack of credit history, right? No score, insufficient credit, no scored, no recent account information, not scored, no qualifying account. So what does this all mean? This person could very well have accounts on their credit report. They could have no accounts in their credit report. It's going to lead to the same scenario of no scores. So what I mean by that is, for the FICO algorithm to generate a credit score, there must be payment activity within the last 6 months. So if they have closed accounts on their credit report, doesn't matter if there's 10 closed accounts, 20 closed accounts, if there haven't been any payments with those accounts within the last 6 months, they're not going to have a credit score factor, because the FICO score algorithm, the whole goal is to assess risk. What is this person's ability to pay? Well, if we have no recent data to base that information off of, it's just not going to create a score. Now, the second that they, let's say, open a new account, or maybe they just haven't used their credit card in over 6 months, so there's nothing reporting. Let's say the second they do a transaction, all of a sudden, all those closed accounts are still going to factor in. The score itself, it's just like a fail-safe, I guess is the best way to look at it. No activity, fail-safe, no score, right? So it's all going to factor in once there is some sort of activity that's generated, but that can be a fairly easy fix. And if they have no credit history at all, then it's going to take them a little bit of time for a score to develop, as we do need that 6 months of credit history. We do have some solutions that we provide through the form of a credit establishment plan that will allow them to get those scores generated quicker than 6 months. So if that's something that you're needing, or your borrowers are needing, we can provide that plan to them as well. Okay, so in this scenario, we can see that having no credit cards is the biggest factor into dropping the credit score after the delinquencies, of course. So this one usually surprises a lot of people. So the lack of recent revolving account information, or lack of recent bank revolving, same thing. So 2 different reason codes looking at the exact same thing on one bureau. Basically what that one is saying is 30% of the credit score, what factors into your credit score, is utilization. But if you have no revolving debt extended to you at all, well, you're losing out on that, and it's actually negatively impacting your credit score. So this could be a very quick fix for a borrower, right? They may just need to open a credit card. Fixed. Now, you're going to have a letter of explanation for that, of course, but that's an easy solution. And you may see this credit score of 548. Well, just this, because it's worth 30% of the score, that could bump them up into the 600s, as crazy as that is. Now, there's still going to be more work that they have to do. We want to do more credit building options, adding things on their report they're already paying for through self-reporting. That can boost their score even further and create, again, a little cushion for these delinquencies. So while I know some of these scenarios, or what I'm showing you for credit scores, are a lot lower, know that this is applicable to any sort of credit report. I just disproportionately have lower credit scores that I see because we do credit repair. So just wanted to call that out there for these examples. But yeah, so hopefully that all makes sense. Okay. All right. So what kind of results are actually possible from being able to make these interpretations? I want to give you some real examples that we've worked with loan officers on where they didn't necessarily need credit repair. So recommending, example number one, recommending the addition of an authorized user increase the mid-credit score for one of our partners, Tabitha's client, by 27 points, bringing the credit scores to 672, 675, 685. This need was identified by seeing that reason code, length of revolving time since accounts had been established. So basically that's hacking that system, hacking that algorithm of creating more longevity by adding an authorized user. Pretty simple solution. We've got a solution very quickly, gets the scores where they need to be. That transaction can go through when it couldn't before. Client with no credit score was provided with credit establishment steps. Started with no scores on 8/19 and by 9/13 had scores of 7/19, 7/57, and 7/56. That's a game changer. Went from having nothing to having exceptionally strong scores to get them to a point where they could qualify for a great mortgage product. Client had a new collection added. So in this scenario, this was a credit repair scenario, but I wanted to kind of give the whole gamut of examples. So the scorecard showed that the only real substantial issue was delinquency related. So this, I call it the scorecard. There's a decision tree looking at all these leading to each of those reason codes that impacts the score. It's called a scorecard. Anyway, so the only thing that was really substantial, because remember on these stronger credit scores like this, many of these items are less valuable, worth less points, right? Inquiries are only 10% of the score, as that example shows again. So the only substantial impact was delinquency related, that brand new collection that was added. So the removal of that collection brought scores from 700, 630, and 640 to 799, 793, and 701. So these all tie together. So 700 to 799, 630 to 793, and 640 to 701. So this example is meant to show that in certain cases, and this person was trying to buy investment properties. So in certain cases, it may be best to wait to resolve a blemish like that, because somebody who has an exceptionally strong credit score, when there's only one really strong item like one collection, regardless of the collection amount that's impacting their score, it can have such a substantial drop in their score. And with the removal, a substantial increase, putting them right back into a great position again. So last example, client with a thin credit file who had multiple accounts with late payment history, only needed 10 points to qualify, no rapid rescore option. All the account balances were paid down. So their goal before going to their lender was to pay off all of their credit card debt, hoping that that would fix the solution. They had a lot of delinquencies with the credit cards while they were going through some hardships that were COVID related. And the whole idea was, if I pay off the debt, then maybe I'll be able to qualify. But they were still about 10 points shy. Now we created a cushion on their credit report. So remember how I mentioned we can add good information to the report to kind of help diminish the impact of some of these negative payment history. And that just shows that you're credit worthy, that you have the ability to pay things on time. So long story made apparently very long is it did increase the mid credit score by 31 points. So they were able to even surpass that 10-point requirement to hit that minimum qualification to get the mortgage. So in all of these scenarios, borrowers either would not qualify or would not get as good of terms as they had hoped for on a mortgage product. And by being able to read the reason codes and understand how the FICO factors impact each of those reason codes, proper advice is provided. And that creates the increase in the credit score, meaning closing of those loans that may have just fallen through the cracks like so many other people do in the US, right? Part of that 65% of people that don't go to the table. We want to bridge that gap. So a long time ago, I mentioned that I was going to come back to refinances. We're getting there now. So refinances are likely to go down, but they're not going to disappear. And I think that's important to focus on. But the way that they're approached may need to shift. So I want to touch on that a little bit. So refinances before were largely rate driven, right? It was all focused on getting a lower rate. Refinances now are likely going to be a cash flow conversation rather than an interest rate conversation. So how do we target the right borrower for a refinance during the shift? We know that there's still a lot of equity that exists, right? A lot of people have equity in their homes. We've seen the appreciation in the value of real estate. So you may still see cash out refinances for consumers that have high interest consumer debt, like credit card debt. So I'm going to touch on why that may be a little bit. Credit card debt has increased by 42% during the pandemic. So 42% of Americans increased the amount of credit card debt they had, said in a better way. On top of that, now what we're seeing is credit card interest rates are increasing. So this means consumers are paying even less to the principal balance on their credit cards, and they're taking even longer to pay off that credit card debt. And this is because the interest rates on credit cards are variable rates that are tied to the federal funds rate. So as the prime rate goes up, the credit card interest rates also go up. And a lot of consumers are feeling that. So current rates are averaging on the lower end of 16% up to 24%, and in some cases, a lot higher. So there is no cap on what interest rate a credit card company can assign to a consumer. So that's really important. Some people are paying 29%, 30% interest on their credit cards. So this can make refinancing a significantly more enticing solution. Why? Well, one, it creates an amortized payment schedule for that credit card debt. Most consumers take about an average of 20 years to pay off credit card debt. That's an insanely long time. And when we're thinking about those interest rates, I mean, most of what they're paying is just going straight to interest. So not a good scenario. And this is especially that time frame, that 20-year time frame is especially due to the way the minimum payments are assigned by credit card companies. Most credit card companies, the way they assess that minimum payment, it's with a goal of taking 10 to 15 years to pay off that full balance if they don't use that credit card at all anymore, which is often not the case. So here's an example. If an average person with a credit card debt in the amount of $5,525 makes only the minimum payments, it would take them 16 years to pay off the debt with the average amount of interest paid of $6,000, meaning they paid $11,525 over 16 years. $11,500 just to pay off 55. So moving the payments to their mortgage provides them with higher monthly cash flow, right? Less money going out the door. It can put them in a better position to where they can save and hopefully not feel spread so thin or even living paycheck to paycheck on a monthly basis. That can also improve their credit scores because it's going to change that utilization ratio on their credit report. And it creates room that they never would have had otherwise. It can help them afford the current rising costs, the inflation that we're seeing right now, and keep them from putting even more credit card debt, more things on credit cards and creating more credit card debt for themselves, because now they can afford their day-to-day expenses like higher gas prices. So this would be a solution-oriented approach. This would be that approach of providing value to your client by changing their entire financial picture and creating that affordability. And so this is what I mentioned earlier, focusing on the solution and that feeling that it can provide to them. This would embody that, this type of solution would. So I just thought I would mention that when it comes to refinances. So what's next? So what's next is now you can qualify more borrowers. That's the whole point, is being able to qualify more people and get them to the closing table. Having more satisfied clients as you're helping them secure better terms on mortgage products and closing loans that other loan officers can't. You want to rise above your competition, right? You want to be the person that people look to as the expert and the best resource. So you don't feel like you're trying to be like, oh, I need to stand out in the sea of your peers. It's going to be very apparent that you have solutions that nobody else can provide. Now, we have really just scratched the surface, to be quite honest, when it comes to understanding how you can utilize credit to close more loans. And there's so much more you can know. So know which factors influence lender decisions and how you can use those to your client's advantage. You can know more about which line items you need to pay the most attention to on a credit report. So which trade lines in order to boost your client's credit score and exactly how to do it. So you can utilize us as a trusted resource. We offer free partnerships to all professionals, all loan officers, real estate agents, in the form of advising you directly on credit reports or for credit repair for the clients that are much further from qualifying, right? They're in the 400s, low 500s, mid 500s, where they just have a lot on there and you're not sure what to do. Our process takes about 6 to 8 months for someone in the 400s to 500s to get them to the 700s. But to learn more about everything else that you can do, we do offer the course called Creditworthy that will dive into even more valuable information than what you already learned today. So here's the details on that. You can go to trycreditworthycourse.com or creditworthycourse.com if you want to watch our video that talks about it. It does provide you with 52 pages of content you can use for yourself and for your clients, guides for your clients on how to read their own credit report, for you on how to read it, so you can go step by step, as well as some marketing material that you can use with prospective borrowers as well, so they can put themselves in the most enticing position to get the best terms. There's 6 modules, 33 videos, about 6 hours of content that's included. We do offer separate webinars and Zoom sessions where we'll review real credit reports and go over the scenarios that you're experiencing day to day. That way you can learn from other loan officers and what they're experiencing and other professionals. So that's something you're interested in, check it out. If you want to partner with us more on the credit repair side, I will be emailing a recording of this. So you can always reply to that email or visit us online at incitestrategies.credit, and then you can